When you decide to invest your hard-earned money, you will hear two words over and over again: stocks and bonds. Stop. Do not get intimidated. These are simply the two main tools you will use to build your financial future. Think of them as the fundamental building blocks of your investment portfolio, like the bricks and mortar for a house. Understanding what they are and how they work is the first, most crucial step toward taking control of your money and making it work for you. You cannot afford to be financially illiterate in today's world. Knowing the difference between these two is not optional. It is essential for your financial security and your ability to achieve your dreams. Let's talk about stocks first. When you buy a stock, you are buying a small piece of a company. Yes, you become a part owner. If you buy a share of Apple, you own a tiny fraction of Apple. It is that simple. You make money in two primary ways. First, if the company does well and its value goes up, the price of your stock also goes up. This is called capital appreciation. You can then sell your stock for more than you paid for it. Second, some companies share their profits with their owners, the stockholders. These payments are called dividends. Stocks offer the potential for high growth, but they also come with higher risk, because their value can go up and down dramatically. Now, let's look at bonds. A bond is much simpler. When you buy a bond, you are essentially lending money to a company or a government. You become the lender, not an owner. In return for your loan, the entity that issued the bond promises to pay you back the full amount, called the principal, on a specific date in the future. Until that date, they will also pay you regular interest payments, much like a bank pays you interest on a savings account. Bonds are generally considered safer and less volatile than stocks. The trade-off for this safety is that they typically offer lower returns. They are the steady, reliable part of your investment plan. So you have stocks, which give you ownership and the chance for big growth, and you have bonds, which are loans that provide steady income. One is like the accelerator in your car, and the other is like the brakes. You need both to get where you are going safely and efficiently. Stocks are for building wealth over the long term, harnessing the power of growth and innovation. Bonds are for preserving the wealth you have already built and generating a predictable stream of income. The key to successful investing is not choosing one over the other, but understanding how to use both of them together to create a powerful financial strategy that is right for you. The big question every investor must face is how to balance stocks and bonds. The answer is not the same for everyone. It depends on three critical factors: your financial goals, your age, and your personal comfort with risk. You must be honest with yourself about these things. Are you saving for a down payment on a house in 3 years, or are you saving for retirement in 30 years? The timeline of your goal dramatically changes the game. A shorter timeline means you need more safety, pushing you toward bonds. A longer timeline gives you more runway to recover from market downturns, allowing you to take on the higher risk of stocks for potentially greater rewards. Your age is a powerful guide in this decision. If you are young, in your 20s or 30s, you have time on your side. Time is your single greatest asset in investing. You can afford to take on more risk because you have decades to ride out the inevitable ups and downs of the stock market. Therefore, a younger investor's portfolio should typically be weighted more heavily towards stocks. As you get older and closer to retirement, your focus must shift from growing your money to protecting it. You no longer have the luxury of time to recover from a major market crash. This means you should gradually shift your portfolio to include more bonds and fewer stocks to reduce volatility. Next, you must have a heart-to-heart with yourself about your risk tolerance. This is about how you feel when the market goes down. Can you sleep at night knowing your portfolio lost 15% of its value in a month? Or would that cause you to panic and sell everything at the worst possible time? If you are a conservative investor who prizes security above all else, you will naturally lean toward bonds. If you have a stronger stomach for risk and are excited by the possibility of higher returns, you will be more comfortable with a larger allocation to stocks. There is no right or wrong answer here, only what is right for you. Lying to yourself about your risk tolerance is a recipe for financial disaster. Ultimately, choosing between stocks and bonds is not a one-time decision. It is a dynamic process that evolves as your life changes. Your financial goals will change, you will get older, and your feelings about risk might shift. That is why it is so important to review your investment mix regularly, at least once a year. This allows you to make sure your investments are still aligned with your current situation. The goal is to create a personalized strategy that helps you reach your financial destination without giving you sleepless nights. It's your money, and you need to be in control of the plan. You've heard the old saying, don't put all your eggs in one basket. In the world of investing, this is the golden rule, and it has a name: diversification. Stop and think about what that really means. It means spreading your money across different types of investments to reduce your overall risk. If you put all your money into the stock of just one company, you are making a huge bet. If that company fails, you could lose everything. But if you spread your money across 20 different companies in various industries, the failure of one company will have a much smaller impact on your total portfolio. Diversification is your #1 defense against the unexpected. This principle applies not just to individual stocks but to asset classes as well. This is why owning both stocks and bonds is so powerful. Historically, stocks and bonds often move in opposite directions. When the economy is booming, stocks tend to do very well. But when the economy slows down or enters a recession, investors often seek the safety of bonds, causing bond prices to rise while stock prices fall. By owning both, you create a buffer. The gains in one asset class can help offset the losses in the other, leading to a smoother, less volatile investment journey. This is not about trying to eliminate all risk. It is about managing it intelligently. Let's make this even simpler. Imagine you have an investment portfolio that is 100% in stocks. If the stock market has a terrible year and drops 30%, your entire portfolio drops 30%. Now imagine your portfolio is 60% stocks and 40% bonds. In that same bad year for stocks, your bonds might actually go up in value, let's say by 5%. While the stock portion of your portfolio would lose value, the bond portion would gain value, cushioning the blow. Your total loss would be significantly less than 30%. This is the magic of diversification in action. It helps protect you on the downside so you can stay invested for the long-term upside. True diversification goes even deeper. Within stocks, you should own shares in companies of different sizes, large, mid-size, and small, and from different sectors like technology, healthcare, and energy. You should also own international stocks, not just companies from your own country. Within bonds, you can own government bonds and corporate bonds with different maturity dates. The easiest way for most people to achieve this level of diversification is by investing in low-cost mutual funds or exchange-traded funds, or ETFs. These funds hold hundreds or even thousands of different stocks or bonds, giving you instant diversification with a single purchase. Building a successful investment plan is not about timing the market or picking the next hot stock. It is about creating a disciplined, long-term strategy that you can stick with through good times and bad. The first step, and the most important, is to clearly define your financial goals. What are you saving for? Retirement, a child's education, a new car? Each goal has a different time horizon and a different level of importance. Write them down. Be specific. Knowing exactly what you're working toward will give you the motivation to stay the course when things get tough. A goal without a plan is just a wish. Once you know your goals, you need to establish your asset allocation, which is just a fancy term for how you divide your money between stocks and bonds. As we discussed, this mix will depend on your goals, age, and risk tolerance. A common rule of thumb is the 110 rule, where you subtract your age from 110 to find the percentage of your portfolio that should be in stocks. So if you are 30 years old, you might aim for 80% stocks and 20% bonds. This is just a starting point, not a rigid law. You must adjust it to fit your personal comfort level. The key is to make a conscious decision and write it down as part of your investment plan. After you have set up your portfolio, your job is not done. You must commit to monitoring your investments. This does not mean checking them every day. That will only lead to anxiety and foolish decisions. Instead, schedule a financial checkup for yourself once or twice a year. During this review, you will check if your asset allocation is still on track. For example, if stocks had a great year, they might now make up a larger percentage of your portfolio than you intended. Rebalancing or selling some of the winners and buying more of the underperforming asset class brings your portfolio back to your target mix. This disciplined process forces you to sell high and buy low. Finally, the most powerful advice for building long-term wealth is to be consistent and patient. The path to financial freedom is a marathon, not a sprint. The best strategy is to automate your investments by setting up regular automatic contributions from your paycheck into your investment accounts. This approach, known as dollar cost averaging, ensures you are consistently buying, regardless of whether the market is up or down. Over time, the power of compound growth will work its magic. By understanding these fundamentals, stocks, bonds, diversification, and disciplined planning, you are not just investing money. You are building a secure and empowered financial life for yourself and your family. That is a goal worth fighting for.